Hello and welcome. In this month's on-demand webinar, OJM Group Wealth Advisors Andrew Taylor and Adam Braunscheidel recap the financial markets performance in 2017. They discuss the first quarter's volatility and provide an outlook for the stock market and other asset classes in 2018. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. OJM is pleased to announce the publication of our newest book, Wealth Management Made Simple. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Thank you for tuning in. My name is Andrew Taylor, and I'd like to begin by sharing our agenda. I'm going to discuss volatility and the increase in vol in Q1 of 2018. We're going to spend some time addressing our outlook for the remainder of the year, and then also we will discuss potential headwinds and share our closing thoughts. So volatility in 2018 was essentially the story year to date. So return of volatility is has come with a force. The S&P went over 400 days without a 3% decline, which is the longest period in history without a pullback of 3%. Streak was actually broken in February as major domestic indices declined more than 10% last month. Markets quickly recovered to offset most of their February losses, and then a second wave of selling pressure picked up last week as the S&P dropped nearly 6%. The VIX index, which is a measure of volatility, soared to nearly 50 in early February, and this was after an extended period of hovering around 10. The index has found a range between the high teens and the 20s over the past couple weeks. So what's the reason for the chaos in financial markets? Well, in February, the reasons were due to a wage report where income of workers exceeded expectation, which in turn then sparked inflationary fear. There was also the collapse of a VIX-related ETF, and then the S&P also broke through a technical support level, which likely initiated a series of computer-based trades and algorithmic trading, which put further downward pressure on the markets. Now, last week's sell-off was blamed on the prospect of increasing trade barriers, particularly the tariff on Chinese imports. Investors became concerned with the prospect of a trade war, which would ultimately be a worst-case scenario. Another significant event was the Federal Reserve's decision to increase the federal funds rate by 25 basis points or 1/4%. The Fed established a more hawkish tone, suggesting that the period of accommodative policy could very well be coming to an end. Quick glance of the year-to-date numbers through last Friday indicate, the extent of last week's sell-off. The S&P, Dow, and EFA each moved into negative territory on the year after the declines we experienced last week. The S&P was down nearly 6%, the Dow was down around 5.7%, and even EFA declined 2.57%. And as you can see, ultimately we're in negative territory for the year, with the S&P off 2.76%, the Dow down 4.28%, and EFA down 2.46%. Now, in concluding our look back at the first quarter, we do feel it's important to note that the last 12 months have actually been very strong. In fact, they've been outstanding. So the news is not all negative. A quick glance at the results over the last 12 months, the S&P was up in excess of 12%. The Dow returned over 16%, EFA over 14%, and emerging markets have increased over 24% over the rolling 12-month period. At this point, I would like to transition to my colleague Adam Braunscheidel, who will share our outlook for the remainder of the year.
Now we're going to take on what we feel where the market's positioned for 2018 and really into the short-term 3 to 5 year next kind of outlook. First, we're going to take a look at the equity side. Really, for us and our team, we have favored international emerging market stocks here for a couple of reasons, but really over the last year and a half, 2 years. And Andy, as he really highlighted, it really played out last year as emerging and international markets outperformed U.S. stocks. Although U.S. stocks were up 22% of the year, we think a lot of that was continued to be driven by expectations of a historic corporate tax cut, which the Republican-led Congress delivered here at the final hour in 2017. We do think that much of the benefit of the tax decreases might be priced into the consensus earnings, that is. So for us, we're very subdued in terms of forward looking. Certainly it's been a great market in the US, but for us, we think there's opportunities globally. And a lot of the reasons why is just looking at valuations. We think valuations here in the US are expensive on a relative and absolute basis. So for us moving forward, that doesn't give us huge signs of encouragement. On the flip side, if you look at PE ratios in Europe and EM, much less than where they are here in the United States. We think that earnings growth should continue to improve and be higher than what the market is expecting internationally. If you even look up last year, you saw the earnings have rebounded in Europe specifically. Earnings growth was up 25% versus up about 14% here in the US. So we think from an earnings perspective, valuation perspective, international emerging is where we want to be for the next year. Although we do understand that certainly equities in general, in absolute terms, might not be attractive given the large downside potential risk there, but we do think that these returns are poised to be better than what we expect from US stocks. We've kind of talked on this, expensive starting valuations, really looking at price to earnings levels really imply future lower returns. If you look at this chart here, just from across right now, we're kind of in that 25 to 30% range. Certainly the market was down here last week, might have pushed these numbers down a little bit. But you can see on a 5-year forward and a 10-year forward basis, 5-year low single digits in really the 1 to 2% range for 25 to 30 times earnings, and then forward, take that even a step further, 10-year returns really in the mid to low single digits again. So for us, when you look at just the downside risk that equities and really US equities here pose for us, we just think there's opportunities outside of the US markets. Internationally, international stocks have recently also outperformed US stocks. We saw that we went through a pretty substantial period of time, really ever since the correction when we hit lows in March of 2009. Really, international has underperformed US stocks. However, that started to reverse course here in the last 6 months to a year. We think that we're in the early innings of that trend. We really see that continuing to play out here in the next year, and then really into the next 3 to 5 years. Here's another way to show you the cycle of US equity outperformance may be turning in favor of international stocks. You again can see really the large outperformance in the US market since the lows. Really from 09 to 17, US stocks were up 123%, international only up almost 11. So again, that's just another continued reason why we believe and continue to favor international stocks, emerging market stocks over US stocks. I'm going to kick it back to Andy here real quick just to discuss a couple potential headwinds and what in terms of what could really derail our thesis as we look to conclude our thoughts.
Thanks, Adam. So a couple common questions we received from clients is, when is the correction coming? Should I take money off the table? So I thought it may be useful if we spend a couple moments talking about some of the things that we look at the potential headwinds that may negatively impact the market. Because right now, all the leading indicators are generally very positive. But what could, and one thing about leading indicators, they tend to turn quickly. So what are we looking at? What could potentially disrupt financial markets? Certainly can't cover every item, which is beyond the scope of this webinar, but a key area of potential concern, at least at some point over the course of the next year or two, would be monetary policy. Now, monetary policy, if you follow the financial markets during the crisis of 2007, there were several rounds of quantitative easing, and one series of steps the Fed has taken to stimulate the economy was to not only cut short-term interest rates, which is the federal funds rate that everyone is likely familiar with, but they also implemented a program of buying long-term bonds. So they bought mortgage-backed securities, the Fed purchased treasuries. It's what they call expanding their balance sheet. Well, it was announced in 2007, it was actually implemented. The Fed has decided to allow the bonds to roll off of their balance sheet. What that means in simple terms is they're no longer going to repurchase 100% of the maturing bonds in the portfolio. Now, the thought process behind that is it allows a policy of what we would call normalization, but it essentially means that long-term interest rates should, in theory, begin to increase. Now, as long-term interest rates increase, what does that mean to the consumer and to businesses? Well, it increases the cost of borrowing. Particularly has an impact on those higher cost items that traditionally are financed: home purchases, auto sales, and then naturally on the corporate side, any kind of debt financing, bonds that are issued. So the cost of debt becomes higher, and in turn, the cost of those items then becomes higher. So this can have a negative impact potentially on the economy. We wouldn't necessarily concern ourselves with a few interest or a slow gradual increase in rates, but if we see an aggressive movement in long-term interest rates, it certainly has the potential to be a negative to the economy. Now, the next item that we're looking at, and this is going to get some media attention as well. You'll probably hear this discussed quite frequently if you follow, a variety of news channels, you read financial publications, and that's the yield curve. Now, historically, the inverting of the yield curve has indicated that a recession is looming. So let's take a step back and, well, what is the yield curve? What does that mean, and why should I care? Well, the yield curve in the chart you're looking at is simply the difference or the spread between a 2-year treasury and a 10-year treasury. So simply put, short-term interest rates generally are going to be lower than long-term interest rates. However, when we have an environment where that yield curve flattens, and the chart that you're looking at, if the line continues to drop towards zero, that means we have a flat yield curve. Now, a flat yield curve is not necessarily indicative of a recessionary environment. However, an inverted yield curve has typically indicated that a recession is coming. In the chart in front of you, you can see there are 3 instances where we faced an inverted yield curve, and in each circumstance, there was a severe correction in financial markets. Now, key takeaway here is, number one, the yield curve is not inverted. It's not even flat at this point in time. Number two, it typically takes anywhere from 12 to 24 months, on average about 18 months, between the time that the yield curve inverts and we actually see a correction in the financial market. So this is a development that we're going to be watching closely, but I wouldn't be overly concerned if you hear the media talk about a flat yield curve. If you see a flat yield curve, doesn't mean that doom is around the corner, but it is something that is worth monitoring closely. At this point, I'll turn it back over to Adam.
So I think a big theme to continue here on the rate story is certainly the Federal Reserve has 2 mandates, one of those being unemployment, which we know that's at all-time lows, continues to be pushed lower. However, they also take a look at inflation, which has been pretty subdued over the last 5 to 7 years, but it certainly has picked up recently. They have a 2% buffer Right now, we're still not there, but for us, it's something to keep an eye on, especially as we anticipate another 3 to 4 rate hikes this year. Obviously, we have new leadership at the Fed with Jerome Powell, so much more to watch there. Something we like to highlight as well that we get from a lot of clients right now in today's environment are, hey, stocks are at all-time highs. Bond rates, as rates continue to rise, that's a negative for bond prices and underlying bond performance. Cash yields aren't really worth putting your money in cash. Where do I invest my money? For us, I think it depends on your time horizon, your risk tolerance. But I did want to point out here on the right side, I think a lot of our clients always kind of in today's type of environment want to dip their toes back into things such as commodities and specifically gold. I wanted to highlight here today, for us, I think gold is a difficult investment vehicle for us to achieve our clients' long-term goals. And you can just see here, looking at the real rate of return since the 1800s, you can see $1 invested in stocks would be worth $1.34 million today. $1 invested in gold is only worth $3.26. For us, to invest in an asset like gold that doesn't pay income, doesn't generate earnings, just for us doesn't make a ton of sense. And hopefully that this chart brings some of that to the surface. Another tool we want to highlight real briefly that we've used is managed futures. Managed futures really are a tool, a vehicle that should help diversify, kind of give you that downside protection when stock markets aren't doing well. Hopefully this helps illustrate that. In the turquoise bar there is actually the managed futures trend index versus the gray bar is a 60-40 portfolio. And you can see where it really helps is on the downside. You look at the last two really correction periods of early 2000s and then 07, 08. Stock markets really were down, and obviously a 60-40 portfolio down as well. But managed futures managed to have some significant performance, both in the double digits, above double digits there in both of those time frames. So look at the managed futures as a potential sleeve. Andy already highlighted this early in the presentation, but this is really a historically low volatility environment for U.S. stocks. You can see the number of +1% or -1% days in 2007 was really one of the lowest it's been in 40 plus years. Really not an abnormal thing, so it's to be expected. Really last year was an abnormal year in terms of really the subdued volatility of the markets. And then last, I just wanted to kind of point this slide out there. I think it does a good job in terms of a lot of folks we've been talking to recently have tried to ratchet up their risk tolerance, meaning add more equities into their portfolio as the market's done as well as it has. Hopefully this slide, you see there the green bars, the S&P 500, you can see from the lows there on the left side and just before, right around March 2009. In terms of getting back to even, we always talk about limiting your negative returns because a 50% correction takes a 100% rate of return just to get back to even. And you can see here, the S&P portfolio took 3 years just to get back to even versus a 60-40 portfolio only took about 1.5 years. So for us, I think this slide really helps illustrate to clients and potential clients just how wide of a ride you can really take. Certainly the stock market's up 400% since the lows, but how wild of a ride can you take without becoming too emotional in your investments? A lot of folks realize that they can't take that ride of just the S&P 500. So for us, it's about diversifying and adding in other asset classes to help offset the downside of the equity markets. Thanks for watching.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by visiting ojmbookstore.com and entering the code OJMWEB at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.